Hi everyone, some of you are probably smart enough to think I'm in Ohio because this carousel used to be at the state fair of some shape or form. I think it's Youngstown, Ohio actually. But no, I'm in Dumbo like last week, except, just let me get my coffee. Except this week I'm avoiding the Manhattan Bridge, which is over there because of the train noise, and we're going to go in front of the Brooklyn Bridge, which is right in front of me. And sure enough, here comes a train. Okay, well, it's needless to say, been an interesting week in oil. They all are. And I was up bright and early this morning, 3 a.m. for the BP conference call. Actually, that's a lie. The BP conference call is 3 a.m. Houston time. It's 4 a.m. New York time. And, I suggested to the company, maybe it might be smart if you want more US investors, which is what you desperately need, quite frankly, given the stock has been basically a rank performer compared to just about anything. I mean, it's down 15% since 2019. During the same time, the S&P is up 80%, to give you an idea. Shell is flat. Chevron's up about 20%. So BP's been a real bad underperformer, and of course a huge part of that has been the strategy that they announced in 2020, which was sort of an end of the oil age. We're going to become a energy transition conglomerate, which just sounds as bad as it is. And so we're still very critical of the strategy. Of course, they've backed off the more extreme version under Bernard Looney, with the new CEO Murray coming on today and essentially, well, doing what they should have done all along, which is crank up the buyback. What they shouldn't have done is spend a whole load of money on solar. And sure enough, today they've just announced that they're doubling their investment in Lightsource, the solar play, the global solar play, which, I just don't think BP should be involved in solar. It's as simple as that. They have no license, as I've said, to essentially, having done a relatively poor job of oil and gas, why on earth would the market believe in them as a solar developer? In due course, hopefully they'll spin it out and look like heroes. But for now, the reason Lightsource is selling itself for what looks like 2 times EBITDA, the partnership, the 50%, the other 50% selling to BP for what looks like 2 times EBITDA with a ton of debt, is basically probably because they lack financing. So BP's just making the same mistake again. They're essentially taking their profits from oil and gas, which is where they make all their money, and shoving it into solar, which, it's just not their job. We like focus, we like Permian focus plays. We like things like Diamondback, it's pure play Permian. We're just about okay with multi-basin oil and gas, but we have no interest in companies that are energy transition conglomerates led by oil and gas. It just makes no sense. And by the way, if you're trying to please the environmentalists, you never will. That's why we think Shell and BP should merge and then unmerge with a better portfolio on each side to make Shell into a global LNG player, make BP into a global deep water player, and take both companies to Houston. Or we've even suggested Dubai or Abu Dhabi, and go somewhere where people want you. You're never going to make people in Europe happy, and having a strategy to try and make non-shareholders happy is just a losing strategy. And so we've been quite critical of BP this morning. Put the results after the market as well, mate. That way you'll get some US investors listening. So that all came in the context of an interesting week for oil for a couple of other reasons. Number one, we started last week, which I talked about last week, with Saudi cutting long-term capex. We then got into Exxon actually blowing through the top of its capex range for 23, which was disappointing. But we rationalized this and kind of said, look, it's probably to do with getting FTC approval for Pioneer, that they're, talking about such aggressive levels of growth and such high levels of capex. My dog's gone missing. No, there she is. Wait, say hello, Athena. Athena. So basically, sorry, I got horribly distracted because Athena went missing. So Exxon, we're giving them a pass on the capex, but we did wish that they had cut capex for 24 as a result of overspending by $1 billion in 23. That was the money move that would have been better received by the market. When they reported, the stock actually gapped down on the capex blowout, but I think the market kind of came to terms with it. All of this also pertains to probably one of the biggest single issues, if not the biggest single issue of the supply side of oil, which is where is US production going? And we saw some interesting stuff. HFI Research on Twitter has been kind of leading the charge on this, but we've had a lot of client feedback also talking about the restatements of US oil data that we saw through the monthlies, which would be reported by the DOE for November. So you'll recall that essentially US production absolutely boomed according to the weekly DOEs, amongst other measures, in the fourth quarter. But most people don't realize, or a lot of people don't realize, that there is no weekly US production number. They report a number, sure enough, but it's not surveyed. It's just a plug. They just make that number up. And so there's no accuracy to the weekly numbers. The monthlies are properly surveyed, and they came in much lighter, 300,000 barrels a day. I think the number is lighter than the weeklies were implying for US production, which obviously is a big shift in the margin, especially when you consider that also US demand was upgraded. So you had a downgrade to supply and an upgrade to demand, which would help explain why the oil price has been relatively healthy despite what looked like insane growth in US production. And furthermore, in the weekly data, the inventories is the good number. That's what's really surveyed. You got to realize they don't survey production. They didn't used to survey exports until exports became so big that they had to. So essentially there are fundamental issues with the weekly data in terms of how you look at the market. And it's important, as HFI researcher pointed out, that if you're revising the Q4 numbers, which you are quite aggressively, it would also feed through to everyone's forecasts. It would also support why US oil inventories are looking, well, pretty much to be counter-seasonally drawing. Now, we've said this market looks like it's nice equilibrium, $80, $85 oil. It's good for the big oils for sure. And of course, the only problem is that the Saudis, now we've got helicopters, the Saudis have all that spare capacity. But of course, the Saudis have somewhat addressed that by cutting their capex, as we've covered. And we're making the argument essentially that Chevron and Exxon are doing a huge growth burst here in order to get FTC approval, and probably won't continue growth at that level. And the downgrades to US production growth also imply that we're rolling over US productivity, which most people suspect we are. And when that US productivity turns, effectively global marginal oil supply growth productivity turns, that becomes very bullish for oil. And then it just becomes a question of how well demand is sustained. Speaking of which, people are obviously pretty panicky about what's going on in the Chinese stock market. As I said about Hong Kong, very archly, because I'm upset with communist China about what they did to Hong Kong, to say the least. Stock markets don't do so well under communism, and Hong Kong's been an absolute disaster. It makes BP look like an outperformer. And of course, you've got major concerns, the biggest one being this youth unemployment thing, where the Chinese solution to data, and this is what's so funny about people saying the DOE data is rigged. I'm like, dude, if you're going to rig data, you don't make it complicated like this. You just do what the Chinese do and say, hey, we've got 40% youth unemployment, but by the way, we're going to stop reporting the number. That's the rigged number. US DOE data is such a mess that you can tell it's obviously not rigged. That's my rant for the day. So anyway, the setup here is still looking a lot better, I think, than sentiment. What's been disappointing about the past week has been the performance of the group. I thought last week we would have a good week for the oils and a bad week for the market. Client pointed out to me that momentum is the way you play markets, and it's been proved academically. And at the moment, this market just sort of wants to go up regardless of what looks like all sorts of bad things happening, particularly in the treasury market being way oversupplied, and interest rates not coming down, and things being inflationary. But we're not going to panic in January. I think we'll still have a decent year for the oils relative to the market, and I still think the market's going to struggle this year. One of the things we highlighted in the past week as well, which I haven't talked about, is I did a little dive on Virginia. And the reason I did that is because Virginia totally dominates data centers globally, literally. There's a theory that basically every email in the world goes through Virginia. There's a history as to why that is, but essentially it's highly connected, very close to Washington, very close to major defense contractors. And essentially with no Bitcoin mining is an enormous data center market. That is Virginia, just outside Washington. And essentially what I was highlighting is Dominion, the local utility, has had an enormous upgrade to their power demand forecast. And so I looked at it and it's like, man, they just can't meet the power demand here. And I checked in with a former colleague of mine and the best analyst, probably all-round analyst I've worked with, who covers utilities, Steve Fleischman at Wolf. And he just confirmed that, yeah, look, the utilities are struggling to supply enough power today. And the fact of the matter is, this is not a Fleischman point, this is something we calculated. Each of these NVIDIA, what are they called, N100s, is a 700 watt chip. That's the same amount of power demand as a house, an entire house. And they've sold a couple of million of them. So this AI thing is going to cause enormous problems to US power markets. People are getting aware of this, it's just not very well covered. And that's what I covered in the Virginia note. So that was another interesting point when I come to talk about oils versus the market. It's like, yeah, okay, they've sold all the chips, but are these things ever going to actually deliver? Additionally, I was highlighting, if you look at Meta's capex plans, they make an insane amount of money from these incredible products they've got. Facebook, Instagram, WhatsApp, it's just phenomenal. And then they say, oh, by the way, we're going above the top of our range on capex this year because we kind of think we've got to invest a lot in AI. And when you look at the CFO talking about what they're investing in, it's like they don't really know. It's almost like they're just chucking mud at the wall, which is a long way of saying I just don't think AI is going to turn up in the way it's being hyped. That's why I kind of like the oils here, right? Have a great week.